Is the Fed rate cut that we wait for in September actually going to be consequential in rates falling? No, it will not. Now, will rates fall between now and September? Maybe. I don't know. Yeah. That's just going to be based on the information that comes and how that repositions the bets that are being placed with the market. But welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Fed cuts, Fed rates, and mortgage rates, and how those two things commingle, what they mean for one another, and if you should wait for Fed rate cuts in this phase of the economy before you make take any action on buying real estate or refinancing real estate. So we have a pretty clear opinion on that, and I think the most simple way of saying it is they aren't connected. What the Fed does has no direct bearing on what mortgage rates will do or the timing of when you should buy.
Well, for example, I had a client ask me this week, they're like, hey, we have them pre-approved. And like, yeah, I asked, because I was just doing follow-ups. I was like, hey, how's the home shopping coming along? And they said, oh, we saw in the news that it's almost certain that the Fed's going to cut rates in September. So we're holding off to put any offers in until that happens.
I even had some clients this week. I mean, this week is maybe the past 2 weeks. It's been really big. I had some clients, two clients, call me and say, hey, should we call our realtor and extend our closing deadline that we extend the contract to buy the home to get to the Fed meeting in September, because the rate cuts are going to happen and they're going to get a lower rate. And there's so much misconception. This happened a few years ago. I don't know if you remember. I posted on social media. Yeah, they went to zero. And I posted on social media, my hand in the air, like, everybody stop. Mortgage. We got so many calls like, hey, mortgage rates went to zero. I got to get a mortgage.
We couldn't even do our job that day. We were just answering the same question.
It was insane. And it's just not the case. And what I've been explaining to my clients is, if you are so certain because you're hearing on the news, media, social media, friends are telling you whatever, we're so certain the Fed is cutting rates in September. It's basically a guarantee at this point. If it's that certain, the bets have already been placed by the market, and the rates have already improved in consideration of the rate cut in September. So the
markets are reacting based off the news of the headlines of, hey, the Fed is realizing that they need to reduce rates, and so mortgage rates are going to come down accordingly. They're going to react based off expectations. So if right now the market's expecting the Fed to cut rates, and if we see that happen, which we probably will, and odds are 100% right now. When that does happen, we won't see the market shift. Maybe we'll see it shift slightly, but if the Fed were to cut rates more than expected, then we would see mortgage rates come down. Or if for some odd reason the Fed actually keeps rates the same, then you'd see mortgage rates go up.
Yeah, so what I've been telling clients, like, to that exact point, the market, and when we say the market, we're talking about just the general broad stock market, all the people that invest in the stock market, the people that do your 401k, the institutional investors all around the world and in the U.S. That's when we say the market, that's what we're talking about, just broadly the people that invest in the stock market to make a profit and make decisions, like companies making decisions based on certain data points are obviously impacting the market and where the money is flowing. So the market makes money by placing bets. I mean, really, the stock market is essentially a form of gambling. You have to make bets based on the information you have at hand. So it's obviously a little more quantitative, like you can figure it out more. It's not just by chance or luck, but they're making bets based on the information at hand. And by making the right bet as early as possible, maximizes the return on their investment. So they're not waiting for the Fed to drop rates. They're not waiting for that meeting to be like, oh, they dropped rates, perfect, let's make our trades. They're making the trades months ago.
They're behind the eight ball.
Exactly. You'd already lose. So the Fed the markets are putting all of their chips on the table at this point. So I've been explaining this to my clients this week. This is how I've been explaining it. So if we look today, the market says it's 100% likelihood that there's going to be a cut in September. It says there's 63.5% as of right now, 63.5% likelihood of a quarter basis or a quarter point cut, 25 basis points, and a 36.5% likelihood of a 50 basis point cut or a half a point. So it's about 1/3 in favor of a half a point. Now, what could move the markets that TJ was saying is if those odds shift to, hey, there's a 60% chance of a half point cut and now only a 30 or 40% chance of a quarter point cut, now mortgage rates will improve because there are investments and bets are being placed, in other words, in favor of rate cuts, which is rate cuts are in favor of lower mortgage rates. So that's what we're looking at. And so don't wait. Like, you've got to have somebody who knows what the heck they're doing, because the scary thing is, the crazy thing is, tons of people in our industry, even people directly in the mortgage space, not even just realtors, but even in the mortgage world, buy into this same idea that, well, let's wait for the Fed rate cut before we lock you in. And it's like, if you think about it, if they've already bet on the rate cut happening, rates have already improved in anticipation of that. So now for the next month or so, what could happen? Well, if we get an employment report that doesn't look quite as strong, well, now maybe they pull their bet. Maybe that 36.5% of a half point Fed rate cut, they're like, oh, crap. With this new employment data, that's going to not give the Fed as much confidence. So now we're only a 10% chance of a half point and a 90% chance of a quarter point. Well, now the extremity of the cuts being expectations being reduced, rates are actually going to get worse. So in my view, you have more risk at this point of a data point surprising the markets and them pulling, because they can't do anything. All the chips are on the table. All they can do at this point is pull chips off the table. All they can do is reduce their bet on what the Fed's going to do. They can't really, in any meaningful way, increase their bet. Rates can't actually improve much more until we get additional data.
Well, and that's why we always say the market reacts to headlines. We just saw that this week with the jobs reports from last year, the revisions from March of 23 through March of 24. Well, they were off by over 800,000 jobs. Yeah. 1 in 3 jobs were made up, essentially.
Yeah, it was erroneous data. Yeah. And you know what I heard, which was crazy? I heard that once you put all that data into the months that they corrected for that big 818,000, there wasn't a single month of positive job creation.
Which, that's what's scary, is because the markets that whole time, they were reacting based off the headline of employment being really strong.
That's right. Unusually strong. Like insanely strong.
Exactly. But it did not react that way when the revisions come out.
But again, the market making bets on the data they're getting in anticipation of what's going to happen. Yep. So they were making bets that the market was doing better because of the employment data in anticipation of the stock market continuing to grow and rally. Whereas now we hear this data about employment looking worse. Well, now the market's making bets that there's probably more likely a recession, which is why they're buying into bonds, which is mortgage-backed securities, which is why rates are coming down, because there's more investments flowing into that based on what the Fed's doing. And the Fed increasing, you hear the term being dovish. What that means is they do not feel as confident about the path that they're on or the path of the economy. So they're starting to reel things back. That happened again today, actually. And we have seen them go from a path of inflation is still the biggest concern in the economy. Employment and AKA recession is not as big of a concern. To fast forward a few weeks, I don't remember exactly the time horizon here, we're in balance. So now risks of inflation rising back up and risks of employment getting worse, in other words, getting closer to a recession, those two things are in balance now, so the Fed has to shift. And now, today, we hear the Fed is saying now inflation is basically not a concern. They're now going back to saying, we said it was transitory, and then we said it wasn't transitory, but now we actually think it's transitory. The transitory took longer than we thought it. We thought it would be shorter version of transitory.
Shift in 75 days.
Yeah, but the significance of that is they're basically saying inflation's actually not the enemy right now. Now we cannot have patience for any more weakening in the job market because we're getting close to a recession. And I was listening to another thing, which is, so now you got to...
So they have to be feeling like they're behind the curve now when we get reports like we just got this week.
And what information do they know that we don't know yet?
Right, exactly.
Like, that minus 818,000 jobs, like that impacted it, but is there other information behind the scenes that
for sure we haven't even seen yet?
Exactly, because you know that they're getting a sneak peek of data.
Oh
and
yeah,
they have so many people working and just analyzing this stuff, but
only time will tell.
Yeah, for sure.
It will be an interesting couple of weeks. But I mean, I think overall our standpoint is you're never going to be able to time the market. And that's why we have programs of like our Client for Life program. We will waive our lender fees for refinance later on. So that way you can take advantage of getting the house now and then refinance later on at no cost for any lender charges.
Yeah, on any future loan, which is powerful. And that enables you to just get, because we've said this multiple times, but it's time in the market, not timing the market. Sure. How quickly can you get in the market? If you didn't get in yesterday, get in today. If you don't get in today, get in tomorrow. That's the idea, because you can't, like, you think back to COVID. I've told this story a bunch of times. I bought my lot March of 2020 is when I had to close, but I was under contract before any of us knew what COVID was. It hadn't broken out yet. I had like a 4-month contract or something. So I was right in that range. COVID breaks out in a significant way, and I'm like, holy crap. We considered canceling the deal and not buying the lot and not building our house. Thankfully, we didn't, because what I could never have guessed back then with the fear and uncertainty of COVID is that lot values would probably 3 or 4x. We tripled or quadrupled our money on our lot in a matter of a couple of years. And I couldn't have made that bet. I mean, that was just like blind faith. Like, for sure. I should just go forward with this, but timing
but
it just doesn't work. But at the same time,
it wasn't, because I mean, looking at the history of housing, you just know that, of course, over term, it wasn't a get rich quick scheme for you.
Exactly. I didn't expect that. I knew it was a long-term hold, and I knew that, you know what, this is something that we're doing long-term. I've got faith it's going to, whatever happens during COVID, could crash, who knows. But I knew over time it would make money. And that's, I think, one thing that is powerful for TJ and I and the Lassig team just in general is we are absolute, utter, weird nerds. Like one of my main hobbies is watching market data videos and information on YouTube. That's like what I do in my free time.
We're like older YouTube kids, iPad kids.
Yeah. Instead of watching like The Beast, we're watching some guy talking about economics. But the cool thing is we understand, like, we can read the tea leaves, if you will. Like we can understand, like we can draw conclusions on the data that is not what the news is saying. The news is saying something glamorous, something significant, something that immediately makes sense to make you click or make you take action, because that's how they get paid. But what we understand more and more, because this is what we study, and this is what we can share with you, is what's actually happening. This is a prime example of that. Is the Fed rate cut that we wait for in September actually going to be consequential in rates falling? No, it will not. Now, will rates fall between now and September? Maybe. I don't know. Yeah. That's just going to be based on the information that comes and how that repositions the bets that are being placed with the market. But short answer, don't wait. Get in the market quick. Rely on professionals like us. Take advantage of perks and things that people like us offer, like Client for Life, free refinances, so on and so forth. But yeah, I think that's really all I've got. Do you have any other thoughts or closing points?
No, I'm good over here. I mean, if you guys have any questions or any comments regarding this, please leave them in the comments below, and we'd love to hear your thoughts.
Cool.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.